solution for that.
Sorry, I forgot to start the
That's
recording.
okay. So as people are aging, there's been a lot of polls out there, and I find this very interesting that among all of the retirees that are out there, 83% share a very big common concern, and that is, have they saved enough for retirement? 83% of them share that. And out of that, this is what I find so interesting, is that so many have homes, and this figure is actually old, $6.3 trillion in equity. The latest figure was 11.6 trillion in equity.
Wow.
So you have 83% are very worried that I haven't saved enough, but they're missing their biggest piece. They have 11.6 trillion, maybe 11.3 right now, in home equity. So, you know, there's a big piece of the pie that's not being utilized, obviously.
Hey, Becky, can you hit that little arrow to this right there in the middle of the side so it gets rid of that side panel?
Oh,
there's a little arrow where it says send for comments right there, right on the side. Yeah, hit that little arrow right there. Yep.
Oh, because you can.
There you go.
Okay, sorry about that. No worries. So 3 ways to access home equity. Obviously, you can sell your house, right? And there's pros and cons to all these situations. And this is where I'm going to sit down with you and find out, what are your goals? Have you thought of, why were you thinking of a reverse mortgage? Or maybe you weren't at all, but you just have other concerns. So we're going to tap through and go through all these. But why? How can you access the home equity? Sell your house, downsize. That's going to cost you some money, right? And that may be the best thing for you, but we're going to talk about that. Traditional home equity, line of credit. This is pretty popular right now. You hear a lot of people talking about this, but if you're in your retirement years, a lot of times that's not necessarily the best route to go. If some of you remember back during the crash and you had a big line of credit, the banks shut those line of credits down, totally just shut them off. So you couldn't access it anymore. If you're also on a fixed income, they're going to have certain drop periods, and then they're going to turn into a principal and interest payment. And if you're on a fixed income and you were already strapped and that's why you're trying to utilize it, having another payment isn't necessarily the best thing for you either. Some of them are even big balloon payments. So how would we handle that? Or you can look at doing the HECM, the home equity conversion mortgage. So that's designed especially for homeowners 62 years and older. It's commonly known as a reverse, but there are different types of reverse mortgage. The HECM is just one type, and we're going to focus on that because it is the most popular and has the most versatility within the loan program itself. So if you're living in the right size home for you and you plan to stay in your home, it's a really good loan to explore to find out if it's right for you. It is an FHA insured product, which is super important, and we'll go through a little bit of that later. So using your home equity, what can you use it for? Well, the awesome thing is that nobody's going to dictate on how you use those funds. These are just some examples of what people have used them for. Maybe it's just a rainy day fund. That really is the best scenario. It can be used for medical expenses. You can get a line of credit attached to one of them. And again, that's why the rainy day fund would come with that line of credit. And this is what financial planners usually like, because that line of credit has what's called a growth factor, kind of acts like a savings account for you. So later on, if you do have home repairs that you need to do, maybe new roof, water heater, carpet, you can be able to pull that money out as needed. Maybe you need to right fit your home, right? Maybe you need to add some chair railings. Maybe you need a chair to take you upstairs, you know, all sorts of things that we can help you out and plan for that. So it gives you a lot of flexibility and a peace of mind. That's the biggest thing. Retiring with more flexibility, a peace of mind, not having to stress. That's what our silver wave years are supposed to be, right? Less stress and to enjoy life. But many of us are finding out that that's not the case. So who's
I'm gonna interject right here for a second.
Yeah.
So if you could go back a slide.
Yep.
So I wanted, on my side of it, I just wanted to give a little bit of how you could use it. She has it here. like create a rainy day fund. So I call that a credit line for emergencies. So as your financial advisor, I always say you should have an emergency fund. So this is a way that you could create an emergency fund for yourself. A couple of other ways that you can use the reverse mortgage is you can do monthly payments to yourself. You could do a lump sum distribution, or you could do any combination of the above. So emergency fund, monthly payments, lump sum distribution. And the biggest thing is you want to take so when would you use it as opposed to using your investments? So when the market is down, like it is now, and we're heading into a recession, now would be the time that you would tap into the reverse mortgage to help with maybe paying yourself during retirement. Let's say you're retired already and we calculated that you might run out of money. So you would take the reverse mortgage when the market is down, and then you would use your investments when the market came back up. And the best part about these conversion mortgages is the loan process, the loan proceeds to you are not taxable. So that's the biggest thing. So that's my 2 cents in there.
Yes, and that is huge because if Karen can help you calculate out your tax brackets and you can fund yourself a little bit more with this, I mean, there can be 10% saved a year, in your managed assets right there, which is just huge.
Mm-hmm.
So, yeah, pretty critical. And that's the fun part of the reverse that I do like. And it can get a little complicated into that. And that's why it's great to have Karen on our side and your side, to really plan that out. So make it work for you. So, okay. So who's eligible? You do need to be 62 years or older, but with that said, if you have a younger spouse, that doesn't mean that you can't get the loan. That just means they're not going to be on the loan. They will remain on title. So that's something that was changed about 5 or 6 years ago, long time ago with the Heckams. They would just remove that younger spouse off title. And that actually created some issues further down the road if they were the one left. So I'm glad that they came in and cleaned that up. The reverse mortgages have a lot more protection for you these days. And it, at least will allow that younger borrower, if they're the last man gracing the earth with their presence, that they get to still remain in the home and not have to make those principal and interest payments like on a regular loan.
So Becky, we have a quick question from Tracy. She said, I'm 52, doesn't look like this could apply to me for 10 years. So you're only talking about a HECM. There's other loans out there, right?
There is a loan that starts at age 55. So we just need to calculate it out and see if that makes sense for you. And it's smart that, I can't use it for 7 more years myself, but planning's everything. That's the biggest thing I have seen over the few years of 100% concentrating on these reverse mortgages is that people just don't plan out enough. So it's great that you're on here and learning about it now, because you're going to be able to stash money, get your house paid off, get that balance paid down so you can implement this reverse mortgage as soon as possible. Because really that's the key of implementing it when you're younger in your retirement years, and really trying to get the line of credit and letting it sit there for a rainy day fund and letting it grow and grow and grow. So that's okay if you're not quite, of age. You do need to live in the home as your primary residence. Now, it doesn't mean that you can't take a lump sum of money out and go buy a second home with it, because remember, you can use the proceeds for whatever you want. Okay, but you just have to live in the house that the loan is on. Also doesn't mean that you can't have like a mother-in-law unit attached to it, rent a room out. You could even have it as a duplex, and as long as you're living in part of it, right? A lot of people will utilize this just to pay their property taxes, homeowners insurance. Okay, so we do check those to make sure that you have been paying them on time. So there's not too many ways that, or things that we are looking for as far as qualifying. We don't look at credit scores. We're just looking at, are you paying your property tax on time and your homeowner's insurance? And if you have had a hiccup, why? We just want to know why. We want to make sure that you're going to be in a good position to stay in the home and remember to pay those items. So what types of homes? We kind of mentioned condos or duplexes, single family homes. We can do manufactured homes as long as it's on owned land, right? And then it's attached. So it's regular FHA guidelines, if you will. I did help a gentleman purchase a manufactured home in a neighborhood. It was a neighborhood of nothing but manufactured homes. Kind of looks like a park, but it's not. They each own the land. And so that was totally fine to do that. Again, 2 to 4 family units. So maybe you're going to retire and you want to have some of that residual income. So you have a duplex or a fourplex and you're living in one of them. That's a great way for some extra retirement income. We can do that. PUD plan, go, Karen?
I was just going to say, because lots of times manufactured homes are on rented land, right?
Right. And we would not be able to do it in a park. And usually, it's probably not the best for a lot of people to be in those situations anyway, because the park rent increases every year and is going to really eat up your managed assets. And they're usually way higher than what taxes and insurance are. So plan union developments are fine. There's 55 and older retirement communities that we do them in all the time. We just need to, again, to make sure that they're FHA insured if they're listed as a condominium. That we have run into some issues with that. Again, doesn't mean that we can't do a reverse. We just can't do this particular one because it is an FHA loan. Also, with that said, if the entire community is not FHA approved, they do have what is called a spot approval. So we would just need to gather some income documents from the HOA to see if the building itself would meet the guidelines, and then we can move forward. And if not, we would look at doing the, if you will, conventional reverse and see if that makes sense for you.
What does it mean by FHA? What's the criteria?
FHA is a government backed, right, by HUD. So they're backing the loan. The one good thing is, remember how I mentioned that the line of credit, like if you had a traditional home equity line of credit, that the banks cut those off. That's not going to happen on this loan because it is backed by HUD. Gotcha. So people do get confused when you actually sign the final documents that you're signing 2 deeds of trust. They think they have 2 loans. It's one loan, but HUD immediately records right behind the first in case you are utilizing that line of credit. And let's say we have another 2006, 2008 happen and your lender goes out of business. How are you going to get your money? Right? So HUD has insured that loan and you're going to always get your money, even if your house is upside down. That line of credit is going to grow and grow and be guaranteed to compound. So that alone to me is the amazing feature. And as Karen mentioned earlier.
Oh, sorry.
That's okay. No, it's always good to go over because there's a lot of moving parts, that you have options on how to receive those funds. You can take a lump sum, a line of credit, a combination of the two, the tenure, which is, just an equal installment. I'm not always a fan of that, or even if you take the lump sum and draw it all out, I always think it's good to leave some, to leave that line of credit open, because again, it compounds. That's where the whole key lies. For example, let's say you're 62 and you're still going to work a little bit longer, and you have your house paid in full, or maybe you owe 50 grand or 100 grand on it. Get a reverse, pay it off, get that line of credit open. If you're still working, you could pay maybe half of your old house payment into it, right? And then that line of credit's going to be compounding and growing. So, and then Karen's going to be able to help you later figure out when you can pull those funds out. So it makes a lot of sense.
We can run a quote basically that shows, like, if you withdraw when the market's down, here's what it's going to look like. If you withdraw from your investments the other years, this is what it looks like. And then you can see how long your total amount of cash is going to last for you, for your financial, for your retirement planning.
Right. For your longevity piece. Yep. Yep. And it's also shown that when you are implementing that and pulling funds out when the market is down, your sequence of returns, right, that is really important. Pulling it out when the market is down in your early stages of retirement, it's really hard to ever really make up that money, and your longevity piece and what you want to leave for family really gets eaten up. So implementing the reverse can be huge for that. So, and there's a book here that I'm going to give away later that's going to give some great examples like Karen was showing. It has the tale of, I think, two twins in here, and it shows how one implemented a reverse and one didn't. One waited till the end and how much less money he had. So implementing it at the beginning and just letting it sit there and grow is the best thing. Some of these case studies, I'm just going to kind of thumb through quickly because I like to share really my own experiences where it's helped people. Yes, I've helped some out where it's just reduce those mortgage payments, right? Maybe they didn't have a lot of equity and they had just enough to pay off their loan. That's huge. You know, there was a gentleman, he had $2,500 house payment. We were able to remove the house payment. So maybe he didn't get any additional funds out, but he was able to save $2,500 a month, or let's say $2,000 because $500 probably was tax and insurance. But that's huge when you're on a fixed income. And he doesn't ever plan on leaving. So that works out really great. A lot of people are wondering, well, what happens if you end up upside down? Does somebody else have to pay that difference and your heirs will not? The home would just get sold, or they could take over and just pay the loan off, just like a regular mortgage. Okay, just like a regular loan. It's just getting larger instead of getting smaller because you're not required to make a principal and interest payment. Some people have used it just to consolidate debt. I did have one couple do that. They needed to pull out. They didn't owe a lot on the house, but they had some of these other debts looming over them, and it was concerning for them. And they really wanted to fund more, believe it or not, long-term care insurance. They were able to fund his, but not hers. And so this really allowed them to consolidate the little bit of leftover bills that they had, and they liked going out to eat. And they actually were doing pretty okay in retirement, but they could see how things, you know, it wasn't $25 to eat at Applebee's anymore, it's $50. And so they're thinking another 20, 30 years down the road, what's it going to be? So they decided to put this in place and get things in a better spot. Buying a home, a lot of people don't realize that you can use this loan to purchase a home.
Yeah, I didn't know that.
Yeah. So if you're going to sell your house, let's say you net 800,000. Maybe you are going to go move down to Arizona, right? You're going to buy a house for $6 million. You're like, I'm going to pay cash for the house and have 200,000 left in the bank. Well, with a reverse purchase, you could buy that $600,000 house, but you might only have to put 450 down and never have a payment on your principal and interest. Now you got a bigger wad of cash in the bank. So you can end up saving a lot of money. And we just need to run those numbers and see, does that make sense for you? Right? It's just a great way. You know, you might be able to buy a larger home. Maybe you really wanted that other house that had more opportunities for you to grow in, or have that ADU unit in it, right? This accessory dwelling unit to have extra cash. And this is going to allow you to buy it. Another instance, I've got a client right now that I'm working with. She's not comfortable where she's at. She was going to she planned on selling her condo, and she was going to move way far out, way up in Concrete area. If some of you know where that is, up more near the Canadian border. Not really probably the safest area to be if you're older. Where's the closest hospital? Where no families around. And then her agent remembered me and was like, oh yeah, why wouldn't we explore reverse purchase? Now she can stay in the area where her family's at. She can actually buy a small home with her net proceeds. So that's huge, right? That's being around family, being closer to any hospitals as she ages. She's still pretty young, but it's just going to be a lot better for her longevity. So why choose the HECM for purchase? So let's tear into that a little bit. You own your home free and clear. We kind of touched on some of this. Yep, you could put the whole portion down, but again, your money's all tied up into the walls of the home, right? And you can't go if you get a traditional mortgage, yes, you could put a little bit less down. And we've calculated that out. Okay, so I'm going to only put 20% down and put all the rest in the bank and then draw out a little bit each month and make the payment. Well, you're going to eat up that money most likely way quicker than if you just put a larger chunk down and not had a payment. It's a reverse way of thinking, but we can happily crunch those numbers out. I just crunched numbers out for a friend of mine who's turning 62 in March. And he's like, well, why would I want to get a reverse now? You know, he knows he can make it, but it's going to be tight. And I said, well, how much is your house payment? Let's crunch these numbers. So within 5 years, he was going to be able to save like $60,000. He'd have $60,000 more cash flow. He's got 20 years left on his mortgage. So that's a quarter. He had over $250,000 during his retirement time that he was going to save. I'm sure you could use a $250,000 during your retirement time, and he doesn't plan on moving. So when you start looking at it as a financial piece and taking the emotion out of, but I have a mortgage, but it's an asset. So we all need a place to live. And when it's all about cash flow, we've spent our whole life climbing the top of that mountain. We're at the peak. We're descending now. It's a different way of thinking. It's got to be another bucket, an asset that we're looking at. A HECM for purchase is, again, the great way, right? You're putting less money down. It's allowing you to have more cash flow. Okay. Rainy day fund. Karen and I kind of already talked about that and why that's important to have. And the line of credit growth, what we talked about. So having those funds later on down the road. I had a gentleman where he actually had to bring in $22,000 to close to make the reverse work. People said, well, why would he want to do that? Well, he had owed $250,000, right, on his current loan, didn't quite have enough equity, and it was a big payment. So he's like, well, I have the cash. I inherited some money. So if I pay that off, I could at least, that would increase my monthly cash flow for the rest of my life. And then he's like, wait a minute, what is this line of credit about? So if we maxed him out and just paid off his house and he brought that little bit of money in, he wouldn't have had a line of credit, right? Because we maxed out the amount that the lender's going to lend you. And the way they calculate that out, by the way, is your age. It's kind of odd way to think of it, but if you're retiring at 62 or 65 and your life expectancy is 95, you've got 30 years. So they're going to lend to you less. Because if you're not making a payment, right, the loan is getting bigger, your house is still growing in value, but the lender needs to make sure that there's going to be value in the home to pay that loan off, right? If you're 85 or 90 years old, they're going to lend to you a lot more, right? Because you're not going to be gracing the earth with your presence much longer. So this back to the client. So he's like, okay, so that line of credit's kind of cool. But I do have a long time to live and I'm actually still working. So I inherited this money. I actually have an extra 80,000 I can bring in and open that line of credit. It's called overfunding the loan. You can do that with a purchase too. So he did that and he loved numbers. He's a tax guy. He was crunching the numbers. He's like, oh my gosh, if I do that and don't ever touch it for 10 years while I'm still planning on working, I will have almost $1 million more to retire with. So that's just an example as to why getting this when you're 62, putting it into place and letting that line of credit grow. And he was putting a lump sum in, but maybe you're just going to put a little monthly amount in it. You can get so creative with it. And that's why it's important to have Karen on your side to figure out the best strategy. And I'm here with you as well. We can run those figures for you. So that's kind of it in a nutshell. I could get into a lot more complicated situations, but again, every person's situation is so unique. And, you know, it's best for me to kind of keep it a little bit simple for you. And so we can dive into your situation. Maybe it's not for you. Maybe it'd be great for your parents or your uncle or aunt. You know, have them give me a call. Karen and I can help walk through their situation. I'll meet with them, get a lot of information together, and Karen can crunch numbers. And, you know, we're here to make your longevity and your legacy work for you. So let me know what questions you might have. And I'll stop screen sharing.
It looks like we have another question. We have from Marcia, can the line of credit pay off the reverse mortgage for our heirs? Okay, let me make sure I understand. So the line of credit, well, the line of credit is part of the reverse. It's all built in with one loan. So I guess you're saying you want to leave the house to your heirs. So if they're really wanting, and those are questions you should have, many really don't want the house. She said, yeah, that's what she meant.
Money. What's that?
She said, yeah, that's what she meant.
Yeah. Okay. So they would need to fund it with a loan, right? So they would come in and get a loan and pay that off themselves. Now they might be 62 years old or older by the time it's time for that to happen. And they could get a reverse mortgage of their own and pay it off. So, but when you're no longer here or you're living in the house no longer for 12 months, then the loan needs to get paid off. So for example, maybe you're going to fall and you get hurt and you have to go to rehab for 6 months. They're not going to make you pay the loan off. After 12 months and you're going into long-term care, then something needs to be done with the loan. The house either needs to be sold, or if your heirs are really wanting the home, maybe it's a lake property or something, then they're going to need to come in and qualify for a loan and pay that loan off. And they would be able to do that. If the house ends upside down, that's a question everybody has. What if the market and the world's in chaos, the house is upside down and we owe way more? They're not going to come after your estate. They're not going to come after your heirs. That's why the mortgage insurance is there, because it is, again, it's an FHA, it's backed by HUD. The investor's taking that risk and they're going to absorb that. But they are pretty conservative on the numbers, and we go over those amortization schedules with you. There's usually quite a bit of equity left in the house. But if not, you're safe. Your estate is safe. Any other questions?
I don't
see
any. Oh, there's another one. Hang on one second. Oh, Marcia said, great information. Thank you.
You're welcome. And some people, other questions that arise are of a power of attorney for my mom. Can you close with a power of attorney? Yes, we can. It is important when those power of attorneys were put into place. So if you have a power of attorney because your parent maybe has Alzheimer's and they just got the power of attorney and then you're turning around and getting reversed, that's going to be a really hard hoop to get through, because they're looking out for elder abuse. Not that, you know, you would do it, but it's happened. And so those precautions are put into place. So again, plan ahead. Getting power of attorney set up, probably, you know, when your parents are a little bit younger, are important. Making sure that they have real estate spelled out in there. And in like Arizona in particular, Karen, because you have property down there, their power of attorneys have 2 doctors that have to sign off. So really understanding these things ahead of time, because that's created problems in the past. So, you know, being prepared, getting things set up ahead of time. We can close in trusts as well. It's not a problem.
Oh, that's good to know.
Yep.
Okay, well, let's see if any other questions. I'm going to share my screen real quick, but I am going to do a couple of spins. So stay on the line. One for a free financial review. It's a $599 value, and that will be coming from me. And then a copy of the book, The Retiree's Guide to Housing Wealth. So I'm going to stop my share and go to a different screen so you can see the Wheel of Fortune that I did here, and I will spin real quick and see who will go for the first one, which is for the financial review. So it looks like Tracy.
Woo! That's awesome. Love it.
And then I'm going to keep her name in there also for a free copy of the book. So we will spin again. Ooh, look at that. So Giselia, I hope I'm saying your name right. She is the winner of the book, and I should have her information for you in the registration. So, okay. Or if she could put her information in the chat, that would be helpful. So I'm going to close this, stop sharing. Looks like we have one more question. Tracy said, woohoo!
And just so you guys know, you can get this book on Amazon. It's a whole, you know, maybe about $10. It's a quick read. If you're like me, you know, I don't always sit quick to read. It's big font. It's just got some real great basic information in it to really help you plan your future. So thank you so much.
Yeah, thank you everybody for being on today. It was quick, down and dirty. You don't have to make reverse mortgages complicated, and I am here to help if you have any questions about why or how you would use this. You have more questions about, you know, how does it apply to me? Just let me and Becky know. And a quote doesn't cost you anything. So or talking to each of us. We are free to talk to.
Yeah, you got to find
All
out.
right.
It's not